Hello and welcome to our 2022 Crystal Ball Market Outlook. I'm Katrina Radenberg, Chief Investment Officer for Mariner Wealth Advisors, and I am joined again this January by Jeff Krumpelman, our Chief Investment Strategist. Jeff, thanks for joining us this afternoon.
Yeah, glad to be here, Katrina.
Awesome. As many of you that have been accustomed to joining us in the past, this has really become an annual tradition that every January, Jeff and I always look forward to participating in with you. Per usual, we will plan to do a mid-year review update in July that will kind of go back and reassess some of the things we cover today, as well as give us an opportunity to reassess the current environment and share with you any changes that we might be thinking about making at that point in time. We've got quite a bit to cover here with you this afternoon, have prepared some slides. I've got some questions teed up to cover with Jeff as we have him go into some more details. But before we do that, I thought I'd just provide a quick summary of the highlights around 2021 and just an overview of our key thoughts about the equity markets as we begin this new year. So as we think about 2021, I'll go ahead and move to this first slide. The S&P 500 finished the year in a really strong fashion, posting another record close at the end of December as it outperformed, you can see here, U.S. small cap stocks, developed international stocks, as well as emerging markets. It also set 70 new record highs during the year and resulted in nearly a 27% price gain for calendar year 2021. So returns have been really robust, particularly as you look over the longer trailing 3-year period as well. Specifically, 2021 was the third consecutive year of double-digit returns for U.S. large cap stocks, which generated over 26% compounded annualized returns for investors over this 3-year period. So we should all appreciate the fact that this doesn't happen all the time. Further, 4 consecutive years of double-digit returns has only happened twice in modern times. In the midst of the late 90s tech run, and then ironically during the 1940s long-awaited economic recovery from the Great Depression that ultimately occurred due to our country's efforts to mobilize for World War II. So it would be quite rare to see another year of such impressive gains in 2022 if you simply just kind of pay attention to that historical data. So what then do we anticipate with regards to returns that might be in store for investors this year? While we do remain positive and expect the market to post further gains in 2022, unlike the past 2 years in which we anticipated strong double-digit returns for the S&P 500, we believe results this year may be a bit more sobering. With current PE levels hovering at 22 times earnings, additional multiple expansion is just kind of unlikely in our view, and gains are more likely to be tethered to projected earnings growth in more of that 8 to 10% range. So not too shabby, but certainly not as robust as an environment in which we were seeing going into 2020 and 2021. Further, we wouldn't be surprised to see a sizable correction sometime this year prior to moving to higher highs. And this is really based on multiple factors. First, it would really just be quite normal on the heels of roughly 100% cumulative returns we have seen in the S&P 500 over the last 3 years, and the fact that we haven't seen more than a 6% pullback in over a year. In addition, risk levels are rising in a transitional environment of accelerating inflation and shifts in Fed policy. And despite the fact that we do think that these are manageable risks that don't necessarily threaten a positive outcome for 2022, we do believe they'll foster headline concerns and will probably have some intra-year moments of investor angst. And then we also can't forget that 2022 is a midterm election year. And so generally we'll see results that are flat to negative returns through that election period, followed by a relief rally going into year end. And then temporary drawdowns also tend to be higher than average in these election years. So I suppose in a nutshell, what we're really saying here is that we think investors would probably do themselves a favor by having a little bit lower expectations, particularly as we move into these early quarters of 2022. So Jeff, let's bring you into this discussion. How am I doing so far in summarizing, and is there anything that you would add?
Well, we've talked quite a bit about this. No, I think you're spot on, and I wouldn't change a thing, Katrina.
Oh, well, great. I'm doing good so far then. So Jeff, having shared our constructive but more modest expectations for the stock market in 2022, can you discuss our thoughts as to what investors should do as we move into this new year from our perspective?
Yeah, given the robust returns that you've cited and the rising risks that are out there, I know that investors are asking, should I stay or should I go? Should I hold fast to my stock exposure or should I retreat a bit here and take some profits? And our answer to that may be somewhat, unexciting, but our recommendation right now would be to do nothing. And, the billionaire Larry Tisch said, when there's nothing to do, do nothing. But that's grounded in our view of the general backdrop. If we look at the fundamentals, the valuations, and the technicals, we think that they are maybe decelerating a bit from the V-shaped recovery, the robust kind of pacing we saw last year, but they're at healthy levels. On the fundamental front, I would cite the fact that the consumer is just really in great shape and willing to spend. We saw that in holiday, almost 9% growth in holiday spend. On the unemployment front, maybe, the past couple of months, people might be a little disappointed about the payroll growth, but unemployment claims data has been solid, and actually payroll growth averaged 550,000 new jobs per month last year. And we think the data can be revised upward, and there's seasonality and other factors in the data we've seen lately. Manufacturing and service level activity are close to all-time highs. And then the very important stuff, earnings and just profit margins. We're going to see 20% growth in Q4 earnings and 10% next year. That describes a healthy kind of backdrop. On the valuation front, it's true that the S&P is trading at not cheap levels at 22 times earnings. That's a healthy PE. But I think that we find some comfort in the fact that if you exclude the largest 8 stocks in the S&P 500 that are trading at more than 30 times earnings, the other 492 are only trading at 17 times. And that's quite reasonable. And then certainly at these levels of interest rates, stocks are still, attractive relative to bonds. And then on the technical front, I think we note that the long-term price trends of these stocks remain very healthy, and sentiment is actually tilted towards the negative or the skeptical. And that means that there's a lot of money on the sidelines to come into this market if we get any type of pullback that you kind of cite. So I think the addition that I would make to do nothing, there's some nuance to that. We don't literally mean that, of course, but one thing that we would be sure is to, as a client, make sure that you stay in touch with your wealth advisor. If you're hearing all this talk about value versus growth and that type of thing, we would want to be balanced. We've seen massive rotation from value to growth, to value to growth, just throughout 2021. And then we've seen more of that kind of this year. So we'd want to be balanced across those styles. And we also would want to have and be diversified and balanced with international exposure and small cap, because we think international is very cheap, and we think small cap has some catalysts in terms of pricing power, and it's that asset class is relatively inexpensive relative to large cap US stocks.
Thanks, Jeff, for laying that out for everyone. I think that helps us kind of set the stage to dig in more deeply into some of these other topics. But before going into the specifics of our base case for the equity markets for 2022, let's maybe cover one more item from the past. and talk about what are your conclusions about what we got right on the research front last year, and then also a couple of items that we missed.
Yeah, sure. And we always have conversations with ourselves and try and be objective. Think about the things that we did right, and maybe feel good about that, but also examine what could we have done better, what did we miss, and is there something to glean from that and learn from that for future periods. So on this slide, I hate to use the word proud, but please, whatever the word is, I think that we got the market right, and we have for the past couple years on trend. I mean, we were pretty loud, and we go public with this about saying we're looking for double-digit returns in the S&P 500. So for those that stayed invested during that time period, going back to 2020, when you were concerned about COVID, when you had all this concern about inflation and what's the Fed's going to do, we were pretty vigilant on stay invested in equities. We also recommend maintaining a balanced position between growth and value. And we had that head fake early in the year where value looked like it was for a run and everybody was talking about cyclicals. And we were saying, no, 5G and the transition towards electric vehicles and artificial intelligence and data center and cloud, that stuff is not going away. You want to be tethered to some of that. So yeah, these cyclicals look interesting as we reopen, but maintain that balance. Bill has done a great job when I think about, the pieces that he put out on inflation and economic growth. They were just really spot on this year. And so I think we got that right. And we were, I think, also saying the S&P 500, we want to be diversified, but if you put a gun to your head, what would you rather be in domestic or international? What do you think is going to outperform? And I think we were pretty constant in saying we think that large will do better than small and domestic over international. Mm-hmm. Now, we did miss a couple things. And one of the things that we missed was just how strong the market was, how robust these returns were. But I think you would agree too, Katrina, that I don't think we feel very apologetic if you've had folks invested and it just happens to be better than you thought. I'll take that mistake, any day. And the one thing that I think we just did miss, I can't believe how strong these largest of large cap names, the top 8 that we mentioned, how they've been. And we thought growth would be good, but I really have been, and I think we've been surprised at how strong that they've continued to outperform and what kind of impact they've had. Now, these other growth names that we were exposed to also generated positive returns, just not quite as positive as some of the large cap names.
Yeah. No.
So that's it in a nutshell.
Yep. Fair assessment. Totally agree with you. And yeah, I know that we did miss a couple of those nuanced elements, namely the concentrated nature and just how robust the returns would be. But you're right. If we're going to get something wrong, I can't really complain about getting those types of things wrong necessarily. And I think it's important to note that we got the positive trend correct overall, and our message was continue to stay invested, maintain the conviction that we had. And I don't think there's anything necessarily to be disappointed about as we look back on where we were at this time last year and kind of what transpired from there. So maybe now let's go ahead and turn to the future and get a little bit more specific and detailed around our thoughts about 2022. So Jeff, I think now would be a good time if we go ahead and move into the discussion around our base case, as well as other potential scenarios that we see potentially playing out this year.
Sure. So on this slide that you just pulled up, this is an annual event that we always do. And each year we outline 4 cases that we think have a probability of more than 5 or 10% of occurring. And we've laid them out here, and we'll revisit this in July when we do the mid-year review. But we think that there's a 70% probability that we will have positive returns this year. And in our base case, we assign 60% base case to a mid to high single digit return for the year. Now, this is off of the figures, the market closed, the S&P 500 closed, I think at around 47.66 at the end of the year. We're now down below that level. So returns are now, in base case, from this point, are pushing towards that double digit level since the market's off 3%, 3.5%, since the beginning of the year. And in the optimistic case, we think there is a small possibility that we would hit double digit. The backdrop in the base in the optimistic case are above. That's where, Bill is saying 3% GDP growth, Federal Reserve that's going to hike several times, call it 3 or 4 times, we'll find out. And then a 10-year that, we're going to see higher rates. We really think we've kind of narrowed that gap. The slide says 1.25 to 2.5. We really think it's going to fall in that 1.5 to 2.5 kind of range. And you could have a surprise where you breach that, but that's our base case. And we think in that environment, in the base case, we can hold on to the multiples that we've got. If inflation does moderate, which is kind of assumed, in this scenario, that it moderates from these excessively high levels, and you get that earnings growth that's delivered at the 8 to 10% level, then these are the types of returns that you'll see. In the optimistic case, what we're saying is, if inflation really is calmed and benign pretty well, you could get some folks to say, I've had some cash on the sidelines, I'm going to come in and get multiple expansion to that 23 plus level. But we assign a relatively small probability to that. The disappointing case and the pessimistic case, and the disappointing case, 20% probability there, that would be a situation where instead of inflation calming to that kind of 3% level that Bill's thinking and that makes sense to us, on the investment team, the equity team, that instead maybe it's stickier and a little bit higher. And as a result, you get some multiple contraction down below the 20 times level. And the less likely event that is no fun, if you will, would be a 10% probability that maybe we get stagflation. And people are talking about stagflation light. We don't see, and Bill again has been loud about this, we don't see recession on the horizon. And that's what describes stagflation. You get, weaker and weak economic growth and rising inflation at the same time. And the fundamentals of valuations and the technicals just don't call for that right now. The normal signals that you would get from recession, they're absent at this point. So those are the key kind of outlines of what we see next year. I think there's a nuance point that, I would like to make, and that has to do with the correction that you brought up, Katrina. And I think that we do see a higher probability of correction this year. And yes, it's because of, midterms and rising risk levels. But it's just not normal to go this long, without seeing something. And I think that as we talk about Fed rate hikes and that kind of thing, it's going to just stir some extra concern. But we would not take action based upon this at all. Because we do think it will be temporary, it will be very short-lived. And this is a chart that we've all seen many, many times, but I think it's worthy of bringing it back. A la 2020 in March, you can see the bars, the gray bars are the annual returns, price returns only for the S&P 500 year by year going back to 1980. And most of the bars are going up, including 2020. But we had a 34% intra-year in 1 month in March correction. And yet we ended up 16% for the year. And that was because the fundamentals of valuations technicals, we felt like remained positive, and yet there was fear out there. And if you took the head fake and you reduced your equity exposure to a large extent, you missed the 90% rally after 34% pullback, and you got that whiplash. And that's what we're trying to prevent. But we're trying to steel people up and say, don't be surprised in a midterm election year after these types of returns, with deceleration and some policy risks that folks are concerned about, expect maybe softness in the early part and a correction that could occur at any moment.
Yeah. No, I think that's a great point, Jeff, not to get too alarmed about the pullbacks, even though we're talking so much about expecting them, just because of what you talk about with the whiplash.
Yep.
And really, these things do happen even when you look at the fundamental evaluation and the technical backdrop and it remains constructive as it is now, we do need to be prepared for these types of moments. And we worry about things when these FBs and Ts, as we like to shorten them to, are negative. But can you quickly summarize the way we look at these fundamental valuation and technical factors today? And I'll go ahead and move to the next slide here.
Yeah, I think your last comment too is worthy of just, if the fundamentals, evaluations, and technicals or the FETs are negative, you don't want to have rose-colored glasses on and say, oh, don't worry, the market goes up and there are no worries here. But we're just saying that we don't see a market top because of this chart. We call this our yoga chart. And, when things are green on this chart, the blood pressure comes down, it calms us. If everything was red and negative on here, then maybe we've stretched a little too far and, pulled a muscle or something. You need to worry about that. But that's just not the case today. Not to beat a dead horse here, but the economic trends remain positive, whether you're talking about the consumer, whether you're talking about housing, employment, spending, they are still at healthy levels. We've cited the earnings trends, 10% expectation S&P 500 earnings growth next year. That's above the long-term average growth in S&P 500 earnings. Yes, the Fed is hiking. Okay. But my goodness, we're talking about 1.75% Fed funds rate maybe by the end of 2023. We're just going back to normal. That's not even, if inflation's 2% and Fed funds is 1.75%, that's not even positive real rates. Normally you have 1% to 2% positive real rates. So that's still accommodative. And then if we skip down to credit spreads, the bond guys are always really smart. And if you're concerned about things, those spreads start to stretch out. And you can see those in all the historical charts. That's not happening right now. So let's be thoughtful and, maintain perspective on things and not worry about bubbles right now. Valuation, again, that's where we talk about earnings yields of stocks relative to bonds. And on that front, stocks look reasonably valued as in far more attractive place to be than bonds. And then on the technical price trends, you can see the advanced decline line, the number of stocks advancing versus declining continues to be positive. So in a nutshell, this is what we really rely on in our decision-making and mood.
Yeah, no, thanks for covering that. And you obviously covered many of the positive elements that we see in the market backdrop today. And luckily it's not all red for us at this point in time. But let's go ahead and address some of the risk factors that we are monitoring and likely everyone's going to continue reading about through 2022. So let's highlight those and comment on our take on them.
Sure. So we assemble that wall of worry, and there are certainly a healthy number of risk factors that are out there that we read about. Not only read about, they're worthy. I mean, these are things to really examine and look at. You see them listed on the left. And, the first one, inflation. I don't care what words you use. Chairman Powell's criticized for saying transitory or persistent. And, but the question is it here to stay or is it going to moderate? What about policy mistakes? Whether we're talking about government stimulus that some folks think has been excessive, but it's likely going to decrease in a big way in this year. The Fed and what they're going to do. So there are policy concerns. You read about peaking economic data. Yes, it's decelerating. How do we feel about that? COVID, I bet everyone on this phone call has friends now next door that have gotten Omicron. We've had a surge there. How is that going to impact things? What about the midterm elections? And then finally, geopolitical tensions. These first 5 that you see up there, we can deal with and can examine. And geopolitically, you know, when you think about Russia and Ukraine, and you think about China and, you know, what's going on there, or even Iran, and we've got some issues over there. It's really difficult to build around, you know, geopolitical shocks, if you will. So, you know, we focus more on the ones above that can impact, you know, what we're thinking. And the quick commercial is, we think these are manageable risks at present. Bill's been pretty vocal about saying that he thinks inflation will moderate. There are reasons for that. Supply chains will, you know, ease the bottlenecks there. And even those that are, you know, critical of saying that, those that were saying inflation was transitory were overstating. Half of that 7% inflation rate that we saw out there for the month of, you know, December was related to used cars and these other categories. Half of it. So energy prices as well. You know, oil going from 35 to over 80, that should not continue. And they do anniversary, and that will impact and help moderate inflation. So we think that's manageable. We've talked about the Fed just going to normal, and I don't think we're overly concerned with policy risk right now. We watch it. Yeah, peaking, economic data is peaking, but the healthy levels. COVID, we've got a lot of tools out there right now with vaccines and antigens, and we don't show so far the desire and momentum to shut down like we did before. We'll continue to monitor. And midterm elections, it happens all the time. Yeah, we're likely to see a change in leadership in Congress, but once you get the new leadership in there, fear subsides, gridlock is the result, and here we go, the market rallies. But what we really focus on is on the right-hand side here. And all these factors we just reviewed on the previous yoga chart, that they're not perfect, but they're not in a place that would just be yelling caution, caution, caution. Sober returns compared to prior, yes, absolutely. Moderating, low expectations, but positive growth. That's what these are signaling to us.
Great. Thanks, Jeff. So I think maybe now we should, some of these risk factors that you just covered, let's drill down more specifically on some of these that you highlight on this slide. And I think the first one to tackle is inflation, because as you mentioned in your comments here, that really is top of mind for economists, for investors. I mean, I think you and I are both probably having conversations almost every day where this topic's coming up. So let's discuss this risk in more detail.
Sure. So yeah, this in a chart says what you just said. And if you look at the news polls that are taken and you ask investors or consumers, you know, why are you concerned about the economy? 84% in this CBS poll said inflation, and it's higher than any other, you know, risk that's out there: gas prices, COVID, unemployment, whatsoever. And that chart on the right shows, and this is relatively rare, that in a U.S. Today poll, that inflation was more of a concern than unemployment. That seldom happens. So certainly this has the Fed's attention and investors' attention overall. If we go to the next slide, I think that we're pretty objective on this. You know, as we talk about inflation, we think it's going to moderate to that 3% or slightly below or slightly above by the end of next year, which is higher than it's been for 20 years, right?
Yep. And
so the days of deflation and 1.8% or 1.5% inflation, we don't think that's going to happen. We think it will be stickier, and there are reasons for that. It's just not going to be at these levels that are really uncomfortable in our view. Why will it be higher? Why can't we go back to 1.8%? There are a couple of things that are listed on this slide that I think you know, are worthy of talking about. Number one is just as we talk about onshoring again and moving supply chain back to the U.S., that means that low-cost labor and the benefit of outsourcing and offshoring will, decline. And so you get natural inflation just from us getting involved more in the manufacturing process. If we look down at our environmental policies, we probably don't think about the cost of doing that. When you look at the commodities that are required, if you look at semiconductor usage in an electronic vehicle, in advanced driving mechanisms, far huge, higher silicon content, and also the use of lithium and other rare earth metals to do this, to support the planet. And that's going to lead to higher inflation levels. But it doesn't need to be at those levels that derail the economy. As I said before, a lot of this is temporary in certain product categories, and supply chain bottlenecks, they're real. They shouldn't be sustained. Mm-hmm. So what we look for is, as we try and make these calls as to whether or not it's going to be an issue or it's going to be surprisingly sticky, is what about the peak in inflationary pressures? Are the bottlenecks going away? So in the next couple slides, we'll hit that quick. There are three types of bottlenecks that are out there right now: product bottlenecks, transportation bottlenecks, and labor bottlenecks. So we're trying to follow the trends in these different areas. Under the product bottlenecks, can you get this stuff flowing and get the ports opened up so we can get it to the consumer, so we have, presents in time for Christmas and stuff? And when we buy the homes, can we get, that furniture that we want so bad? I don't want to wait 3 months. Nobody wants to wait 3 months. Mm-hmm. And pre-Omicron, that stuff was easing up. You saw the trend in China exports rising in the fall. Now, that good news has ebbed a little bit as you've gotten some fears in China and globally on Omicron. But there are signs that that's peaking, and that means that the export trend should be solid in China. We are hearing from auto companies that they're planning production increases in overtime in fourth quarter and first quarter. So that's a good thing. And the chip companies, if we listen to Micron and Qualcomm, they were saying, that supply constraints were easing. And so we're just trying to follow this. And right now, we think that should contribute towards a moderation in inflation. If we switch gears and go to transportation, here, this chart that you see here, it's the Baltic Dry Index, which is shipping rates per ton of goods shipped. And you can see the big spike that we saw last year, and that's come in a large degree. We'll continue to follow that and track the shipping rates. Logistics companies have said that backlogs are easing. We'll get more data out as Omicron has surged, but I think that we can see that as long as we don't shut down, that pressures seem to be peaking in this category. And then the next slide, we got wages. And one of the quotes I think that you hear is that the cure for high energy prices is high energy prices. And that's true in the labor market too. The cure for higher wages is higher wages. And that will be a clearing mechanism. And as we anniversary or exhaust and expire the unemployment benefits, the tax credits, people want to go back to work. And that should, and we've seen growth in the workforce over the last couple months. So that is a positive and a sign of peaking pressure. And then productivity, you see capital for labor substitution. Capital spending's been pretty solid. That can lead to rising productivity, and a lot of themes that you hear from pretty knowledgeable folks in this business is the expectation that productivity will continue to be on the rise. And in that case, you can't increase wages without seeing rising unit labor costs and deteriorating margins. So we think productivity, it's important to track the trend of productivity, and we're seeing good news on that front. So I think that's a pretty good wrap up on inflation. We're not fools. We don't think it's going to 1.8, but neither do we think it's going to be 7% this time next year. And Bill thinks it's going to be in that 3% or slightly above by the end of the year. And as we all know, it's not absolutes, it's trend that people follow. Doesn't have to be at 3 by June, just needs to be moving in the right direction.
Yeah, no, you make a great point. You know, Bill has written a lot about this topic, and I know the three of us have had conversations. And while we do expect inflation to remain elevated compared to the past 10 years, we look for it to moderate as we continue to move through 2022. And certainly at this point, do not see it derailing the positive stock returns that we anticipate. So I think that does give us a good sense on the inflation front. So now why don't we go ahead and address some of our other concerns that we're monitoring, particularly risk of policy errors and the impact of midterm elections, even though, yes, we are used to having them on a regular basis.
Sure. So we've got a slide. I think I started to, put a slide on here about the Fed and talk about the Fed, but I think we've talked enough about the Fed. We're just going back to normal. So let's set aside that for a little bit, and we'll see in March what happens. But I think this slide I included on tax policy because it shows you how quickly things can change. And this whole idea of don't just jump the worst case outcomes can be something to write down and remember when you're investing in the equity market. It wasn't too long ago when we thought we were going to get a $3.5 trillion infrastructure plan, and that was going to result in the massive tax hikes, larger tax hikes than we've ever seen in the history of our country. And this is a slide that here you can see that blue bar second from the left called for S&P 500 earnings of $220 in 2022. Well, now consensus has come up a little bit as the economy's been a little bit stronger, just updating for how earnings numbers have come in so far. It looks like it's going to be more like 225 for consensus earnings. If we would have gotten those tax hikes in that infrastructure plan, it would have significantly impacted earnings. It would have cut them 5%. So instead of getting double-digit growth, you would have gotten 5% growth next year. Because that's not going to happen. We aren't going to get those corporate tax hikes or other tax hikes, and it's not a threat to earnings growth. So that's a policy thing you can just check and say, okay, that's kind of behind us. Yeah, we might get some kind of plan, but it ain't going to be $3.5 trillion clearly at this time. So that's a policy concern that has kind of gone away. Mm-hmm. It's probably part of the reason why the S&P 500 did as well as it did in the fourth quarter.
Yeah.
Now, moving forward, what about the midterms and politics? And I include this chart on here. It's not a statement whatsoever about our political leanings. It's just looking at historical returns. If we do get the shift in leadership in Congress to Republicans, and there's a chance that it would be a Republican sweep based upon Biden's approval ratings, looking at that historically and what that's meant, along with the news out of Virginia and New Jersey during some of those special elections, it looks like the Democrats are going to give up the House and potentially the Senate. So then you can see a Democratic president, Republican Congress, and actually in those periods, it's been a very fertile environment for equities, better based upon history than what we have right now. So that's just kind of a fun slide.
Yep.
The next slide, though, I think it is more telling about, our thoughts on correction, and maybe it's getting too cute, but our thoughts about how the market may perform. And I think we're a little more positive on it being a more positive result as we move through the year with some chop early on. The chart on the left shows you the various years of the election cycle, year one and year two. Year two is always midterm elections. That's what we're in right now. The blue bar suggests that on average, we get a drawdown in the market of 19% during midterm election years. That's higher than those other years. And that's because of the policy angst about, what's going to happen. And generally people try and shove through all stimulus before that year, so they're looking, pretty, and then the stimulus starts to fall away. And so you get these drawdowns. But you get that rally on the right, you can see flat to down, but then you get that nice rally as some of those fears kind of go away. And to me, it's logical. It's not a major call or something, but that might describe what we experience.
Yep, that's great. So maybe now let's shift away from concerns that are coming out of Washington and move back towards Wall Street and Main Street. How about let's cover our thoughts concerning investor fears about peaking economic and earnings data, as well as the continued fear around rising rates in 2022.
Right. And this is what investors always wring their hands about, right? If you're a football team and you're the Packers or something, and you lose your first couple games, even though there's 17, and you got a great team, people start, oh my God, it's over. Mm-hmm. And so, yes, it's peaking from very high levels, but it still is healthy. And the first piece of data we look at, this is the Institute of Supply Management data. And this is taken via asking purchasing managers of manufacturing companies and of service companies, what are your plans for hiring? What are you seeing in terms of backlogs? What about your delivery times? Are they slowing a bit because it's hard to fill everything because demand is strong? Or are they, easy and that kind of thing? And the bottom line is that whenever those readings are over 50 in those surveys, that means that we're in a growth mode. If it's below 50, you need to be concerned about recession and economic decline. And you can see the blue bar, which is manufacturing, the red is service. They're both well above 50. And if you look at, I guess going back to 07, 08, 09, that's probably the strongest period where, you can just see it. Both of these things need to go negative before you really worry about recession. And this is a signal that we look for. You're far from that right now. So this is just not a concern. It's decelerating, but still at lofty levels. The next slide gets at unemployment. Not a lot of comment here. The unemployment has come way down in terms of claims. I know we got the news today that it had heightened a bit to the 280,000 level, but there's a lot of noise in the data, I think, right now. And even, when we look at the unemployment statistics and probable revisions, there's a big gap between the household surveys and the actual BLS report. The household surveys show that we had growth of like 600,000 jobs. And I think there is, there are a lot of people that are dropping out of the workforce and they're going into work for themselves and they're building their own businesses. That stuff isn't captured in the BLS report. So I think we need to be careful with the data, and we're thoughtful in that. Bill's pretty smart about that stuff. So overall, the employment data is solid. Mm-hmm. And then it gets to earnings. And I'll just have there's a column in here under S&P 500. What that says is earnings were expected to be up 9.7% when you were looking at projections and expectations back in September of last year. If you fast forward to today, analysts expect earnings to grow 9%. That's still very solid. And I think we're going to have, a good Q4. Banks apparently are hiring people. And so, they've disappointed just a little bit. But if you look at loan growth, if you look at all the major statistics, the investment banking revenues are really solid. So I think we're going to be good on that front. And then you get margins. And boy, this is almost like inverted yield curve. People have been saying margins are going to fall for a long time. And they haven't. Revenue growth is strong, very solid. Companies have done so many innovative things with regard to their income statements and their cost structures. Margins are holding up. We'll follow this, but that's a reason that earnings growth should be 10% next year. And then the only thing that I want to highlight on this page as we talk about rising rates, again, we think they're going to fall in that 1.5 to range because we think inflation is going to moderate, and economic growth, it's going from 6% to 3%, on its way probably to 2% the following year, more normal, steady Eddie stuff. And as a result, we just don't see surging rates. And then they are anchored somewhat by foreign rates. Rates are higher in the US than they are overseas. And so the Fed's going away as a buyer, but you probably have foreign buying of our bonds. And that's something to keep in mind. I'm not the expert on this. Sandy certainly is the person to talk to, but I want to address this because it does impact, Katrina, our discussions on equities. And I really put a lot of credence into this slide on the right-hand side, the larger one. This is credit spreads. And I kind of kid, but not really. Bond people have to be really smart because they're scratching for basis points. And, I wouldn't want to go on Jeopardy with Sandy or something. This shows you the credit spreads remain very tight, high yield versus treasuries. And bond investors get concerned. When they're concerned about recession, these things stretch out. And that's not occurring, so that keeps us comfortable. Our blood pressure will go up a little bit if this starts moving in a big way. And our tune may change should that occur.
So Jeff, the fundamentals still really appear positive to us. But as we shift and think about valuation, I think there's a lot of noise around that, and a lot of people are really questioning things from that perspective. So can you talk about our take on valuation specifically?
Yeah, I wanted to put it in chart form because we talk about it, but you can kind of dismiss it. This actually is the lesser appealing chart. If you want to make the case that stocks are more attractive than bonds because of their strong earnings yields versus the rate that you get on a 10-year treasury, this chart kind of makes the case. If you looked at this longer term, what this shows is that orange or that reddish line going across, the average gap between the earnings yield and the 10-year treasury, the difference between the two has been somewhere around, I'll call it 280 basis points or 300 basis points. And that's right about where you're at right now. So it's right on the average going back to 99, which says it's reasonable. Mm-hmm. But the times where you got really concerned were when you were headed into 07, 08, when you got down to levels that were below 200 basis points, or 99, 2000, when actually the earnings yield was below the 10-year treasury. Mm-hmm. And that's not the case. If you look at the longer term average for the earnings yield, or the equity premium, the difference between the earnings yield and the 10-year treasury, it's around 60 basis points. If you stretch this chart back to 1950, mm-hmm. It would look far more attractive. But this is one of the reasons. But that's not to say if this changes, we'll change our view. If mm-hmm. rates rise, the Fed does prove to be behind the curve, and this transitory persistent thing on inflation, ends up it's really persistent, then the case for equities becomes less appealing. But that's not where we're at. And why predict the predictor? And the next chart, when we get into picking stocks, selecting stocks, this is one that I think our investment team embraces, the Ken Powell's and Jeff Krumpelman's and Kyle and the folks that talk to Katrina about our internal equity strategies. You've got the top 8 stocks trading at over 33 times earnings, and we all know these names. They're listed right here. The S&P's trading at 22, but the bottom 492 stocks are trading at 17 times earnings. So there are stocks out there that are trading below 17 times, and it's not as egregious as those that just point to 22 times. This is a market of stocks, not a stock market, which sounds cliche, but that's true. Yeah. And this is an example of that. So anyway, you don't have to be just invested in the S&P 500 aggregate.
Yep. No, makes sense. And so now we hit on fundamentals, you just covered valuation. So why don't we just go ahead and round out the third leg of the analysis that we conduct in our research process, examining the technical price trends. I know that you don't see any major alarms here either that normally would signal market tops, but I think it'd be helpful for everyone if you walk us through that.
Sure. And I'll just look at one of the two slides over here, and it's the one on the right. That's the advanced decline line. And you can see if you drew a line, it still is in a northeastern direction, which is really the key. You tend to get what we call negative dispersion, where when you get concerned of a market top, the advanced decline line starts to roll over while the S&P continues to go up. And that says that, yeah, the market's going up, but it really, everything else is not going up, and just a few are. And you might say, well, gee, Jeff, you just covered a slide that said the top 8. You know, what's going on here is that all stocks are going up, and those others that are not the top 8 are in long-term positive price trends. They just haven't gone up as much as some of these really big behemoths. When things get dicey, like in 99, 2000, advanced decline rolls over, and you get a number of stocks that are in negative price trend while the top 8 are going up. And that's just not the case. So when you combine this with the fact that people are skeptical and the percent of bulls out there has really come down, that tells me that in a pullback, as long as the fundamentals, evaluations, and technicals remain positive, that you'll see this advanced decline line continue to be, solid, as well as returns.
Awesome. Thank you. That was really helpful. Finally, I think if I move to our last slide, a key message that we're really sending to everyone in this environment is to just stay diversified and balanced in 2022. You mentioned it in your opening comments, and we mean that in regards to growth versus value, large and small, domestic, international. So why don't you close, and then we'll leave a little bit of time for Q&A by just discussing our rationale behind really staying balanced as we head into this year.
Yeah, I think, again, that it's important to stay balanced, in several ways. And the first is this whole discussion, and I know clients really aren't interested in, value and growth and dissecting them. But you do hear out there a lot, oh, this is the time for old economy stocks and cyclicals. And well, that's true, but that doesn't mean you abandon some of these great companies that are in the midst of, wonderful themes. You own both. My mom used to say moderation in all things, and including moderation. And I think that's right, particularly now. So this chart goes back, and it does show you that value will go through extended periods of outperformance as growth does. But if you look at that tail end there, you can see this thrashing about. You're in a trendless kind of thing here. And I think that will remain trendless because I think it's innovation that is driving this in both camps. And you get innovation at Deere that's benefiting from, all kinds of advancement in technology and silicone that's going in those, as well as GM. But you also get it out of 2.6 and Qualcomm and so on and so forth. A number of sides. I'm not cherry picking there for compliance. Those are just some examples. And I think you want a blend of growth and value, because 5G is not going away. And if COVID doesn't surge, neither is the case for financials and energy stocks and industrials and materials. So own both of them so you don't get whipsawed there. And on the next slide, we talk about, small cap. And, our discipline believes in diversification at all times, because no asset class dominates forever, and you want to have these different exposures. But it is interesting to us, after underperforming last year in a relatively significant way, small cap stocks are inexpensive, and I understand that a number of them that are in the indices are negative earners, and if you include them, they're not quite as attractively valued. I get that. But these stocks tend to perform well during Federal Reserve rate hikes in the early innings. And it's the only asset class, as you see, you got these multicolors. If you look at the green bars, those green bars represent the return for small cap stocks during those decades. It's the only bar that is above inflation and provides positive real returns in each and every one of those decades. So they're attractively priced. They tend to do well in this economic environment and during rising inflation and in inflationary times. And then if you look at the next slide, this is, we think that international, again, we always feel like you should have exposure there. But I think if you really pushed us, we felt like significant domestic exposure was key, was important, and that if you really pushed us, U.S. is likely to outperform overseas with this COVID stuff going on. Well, we've gotten to the point in this blue bar that says minus 6.89. That's the multiple discount of EFA, Europe, Australia, Far East, Developed International Index, to S&P 500. It's almost 7 multiples cheaper. If the S&P 500 is 21 times, then EFA is 14 times. That's as significant a discount as you've seen in a long time. So they're cheap, and those economies, they're not going away. They're very value tilted. It's more financials. It's more energy. If we do get this big value run, they'll benefit in a big way. So I just want to put it out there that, don't abandon. International has underperformed, U.S. for a while. I don't think want to give up on international. So I think that shuts it down.
Yeah, no, those are great points. And to your point on staying balanced, if you have been somebody that's only been focused on US for all these years and haven't wanted to allocate to international, now is a good time to continue, to start thinking about being more balanced in your domestic versus international allocation. Well, Jeff, this is always a pleasure to have this conversation with you and to really set the stage for the year. We ended up using almost the full amount of time, but we do have a few minutes to spare. So I will go ahead and look through the Q&A here and pepper you with a few more ad hoc if you're ready. And for those of you that have joined us today, I know we won't probably get through all of these, but rest assured we have record of them, and we'll have somebody follow up with you specifically after the call if we do not get to your question. Jeff, here's one for you. Can you address the theme of sell in May and go away, especially with predicting strong recovery in Q4 2022?
Wow. So, it's funny, whenever that comes up, you usually restudy the data, and I could give you plenty of kind of esoteric examples where that just absolutely doesn't work. And, I don't think that you want to run your portfolio via the calendar. The one that stands out in my mind, let's go back to 2020. You had a 90% run through May, June, July, August, and in that time period after that big swoon in March. So that would have been a massive failure if you would have done that. So, without going back and going to Ned Davis and studying some of the stats, we rely on fundamentals, valuations, and technicals, and try to avoid that idea of timing and whipsaw that can happen. I almost view it, and somebody will probably shoot me or send me an ugly text or email. It used to be the dogs of the Dow, right? Mm-hmm. And all these rules that come up, you always pick them the year that they don't. So
yeah. So we're at 4:00, but I want to ask you one more question just because I think it's a good question and kind of an educational one. One of the questions we got was, why do we always measure against the S&P 500 and not the Dow or the NASDAQ when we're doing this analysis and just talking about the market in general?
Well, because the S&P 500 is the broadest index, And, it's not to say the Dow is very old economy and industrials oriented. That's changed a little bit with some of the additions, but historically it's, been in stodgier areas of the market and doesn't include, it may include an Apple, but it's not going to include, something like, I'm trying to think of a Dropbox, or, you know what I mean? It's not going to have some of those really attractive kind of growth sectors that we think are all important. And it's just a much broader index from which to gauge.
Yeah, thank you for that. Well, I do want to be respectful of everyone's time. We are at the top of the hour. As I said before, we will get back to those of you that still have questions in the queue that we did not have a chance to answer live. So somebody will reach out to you. And we just really appreciate your time, appreciate the opportunity to serve you and your faith and confidence in us to help you navigate these markets in the year ahead. We look forward to providing you an update in July, and we hope you all have a safe and prosperous 2022.